I am delighted to welcome you today for this webinar titled From Data to Deployment, Mobilizing Capital for Impact in Sub-Saharan Africa. I think we will still have many people joining, but let's get going with a couple of housekeeping rules while people are coming in. Please use the chat and let us know where you are joining us from. You are welcome to turn on your video. That's up to you. The webinar is recorded and will be uploaded to our webinar page and to our YouTube channel afterwards. You can ask questions in the chat. Please add thumbs or whatever emojis that you like to the questions that you find interesting. If we have time at the end, we will pick some up and to address them to our panelists today. This webinar is organized as part of Building Bridges for Investing in Africa program, together with Tameo, as well as two Pan-African investment networks, AFCA and AVPA, which are both partners of our program. I will further introduce them in a few minutes. In a nutshell, this webinar today will explore how data and market intelligence can accelerate capital flows into impact-driven private markets in Sub-Saharan Africa. The session today is divided in two parts. First, we will have a presentation of the latest private asset impact fund reports by Tameo with a specific focus on Sub-Saharan Africa. This is a unique chance to discover this focus. And I will get into a discussion with colleagues from AFCA, AVPA, and Tameo. And to kick us off, I am delighted to introduce you to Ram Kumar Narayan. He has 15 years of experience in impact investments and currently serves as head of products and services at Tameo Impact Fund Solutions. His experience includes data collections, analysis, and reporting on trends within impact funds and financial institutions that serve low-income and underserved communities. Today, will provide us with a unique focus on Sub-Saharan Africa based on the data that have been extracted specifically for this webinar, the data from this report that I mentioned before, so private asset impact funds reports. And before I give you the floor, Ram, 3 last comments. The slides that you will be presenting will be shared on our webpage after the webinar, so no need to take screenshots. It will all be available. There will be no time, unfortunately, for Q&A right after Ram Kumar's presentation, but feel free to ask questions in the chat. Ram Kumar has colleagues with him today who will be able to answer the questions if you have any. And if you want to receive the report as soon as it's out, I am adding the sign-up link in the chat. Ram, the floor is yours.
Thanks a lot, Boris, for the introduction. Hello, everyone, and thanks a lot for joining our session today. Very happy for the opportunity to give you a first-hand look at some of the key results that we found in our latest market review of private asset impact funds, with a specific focus specifically for this webinar on Sub-Saharan Africa. So just as a glance on the content that we are going to cover in the next 15 minutes. So I won't be able to go very deep in all these thematics here. But as Boris mentioned, you will have access to this presentation once the webinar is over on Building Bridges website. But the idea is to really set the stage, give you a few key takeaways about Sub-Saharan Africa funds, as well as the whole market. And hopefully give you a good frame for the panel discussion that's going to follow. And as a reminder, the Private Asset Impact Fund report, which is a bit broader than what the topic is of today, will be available in a couple of weeks. So you will see the link to sign up, and please do register so that you get a copy once the report is out in due course. So let me start by giving you an overview of the market size as we know it, and also clarify a bit the market segment that we are going to focus on today for this discussion. So this concerns really the two bottom bubbles that you see here in orange and yellow. So we are talking about a subsegment of impact investing, which in itself is a subsegment of responsible investments, falling within global assets under management in terms of the asset management industry. So impact investing as an investment strategy was sized back in October 2024 by the Global Impact Investing Network at $1.6 trillion US. And this market sizing contains, a variety of strategies, instrument, and stakeholders, be it from listed investments to private assets, investment flowing into developed markets, into developing countries, through direct balance sheet allocation, through intermediary asset management companies. So it's really a bulk of the different impact investing activities globally. So at Tameo, what we do is that we start with this and we apply mainly, I would say, 3 filters. So we filter out the listed investments from the impact investing sector. We then filter out also investments flowing into developed economies to only focus on developing and frontier markets. And we only consider investments that flow through dedicated investment vehicles that are managed by specialized private investment managers. And that is the orange bubble that you see, private asset impact funds in developing markets. So this market segment is sized by Tameo as recently as February 2026 to $105.2 billion US cumulatively in assets under management. And then within this presentation specifically, we'll also consider a segment within the PAIF segment of SSA focused funds, so Sub-Saharan Africa focused funds. And I'll tell a bit more about that, but we are talking about a market of 18.9 billion as of end of 2025. And this is going to be the main focus of the presentation. So here, now going back at the broader sector, here you see a slide that showcases the breakdown of the whole market by impact sectors on the left, as well as asset class in columns. So you have 2 tables, one recapping the split by total assets under management. So you can see the total number 105,208 is really $105.2 billion US cumulatively. And then this is absorbed today by 808 different private asset impact funds. And you can see that the market has a specific concentration level. So in terms of sector, you have the multi-sector line, which is at the bottom, which absorbs approximately 1/3 of the market, both in terms of AUM and number of funds. And those multi-sector strategies are, in the internal jargon, they are called sometimes the generalist impact funds. So they target really multiple SDGs within their value proposition. So they dominate the market. They are followed by climate and renewable energy funds at the very first line. At about 1/3, 26% in AUM and 22% in number of funds. And then ranking 3rd is the microfinance strategies, approximately 1/5 of the market in total volumes. So I'll let you keep a bit those concentration levels in mind, because we are going to see how different is the market when we look at only funds investing in Sub-Saharan Africa. So here, as a segue, this is really, showcasing a bit the split of the same market based on the regional allocation of those funds. And as you can see, the bubbles on the top, here you see that the prime investment strategy in terms of region is multi-regional strategies. So you have 294 funds out of the 808 that have a diversified multi-regional approach. But then when you look at only single region allocation strategies, you have Sub-Saharan Africa leading the way when compared to Latin America, Asia, and other regions with 240 funds. So these 240 funds are the ones that we are going to focus our discussion around. And today, these funds are cumulatively managed by 183 impact fund managers, domiciled in 36 different countries. And cumulatively, as I mentioned before, their cumulative AUM for those funds is 18.9 billion, which is approximately 18% of the total market. And then just a final point on that, we also look at how much Africa is allocated towards as part of multi-regional strategies as well. And we know that in total, when you consider both Sub-Saharan Africa funds of the 240, and you add those funds that have a bit of Africa in their multi-regional approach, then the total goes to 469 funds targeting the region, which by far is the biggest regional allocation of all. And now, in the next couple of slides, I will really focus on the 240 funds and those that I'm going to call the SSA focus funds. So those are funds really investing solely in the region without any other regional exposure as part of their portfolio allocation. And I'll start with a few comments on the market activity since the 1990s. So this chart shows you the number of new funds being created every year that are focused on Sub-Saharan Africa. And as you can see, the market really has started to take off, I would say, maybe 20 years ago, around 2005, with really a peak post-COVID, I would say, with 2023 values being record values. In 2023, there was about 45 new funds focused on Sub-Saharan Africa, which is contrasting to the last couple of years, 2025 and 2024, where the market has been challenged by different elements, where the fundraising has become a bit more complex, and the number of new funds being created has reduced quite a bit, especially in 2025. So it's not necessarily an Africa kind of factor. This is also something that we see more broadly in the private asset impact fund market, where market activity has seemed to slow down a bit in the last couple of years. And finally, the yellow line that you see here, you have to read it on the right axis. It shows you the number of funds that were operational, so active at the end of any given year. And you can see that it grows exponentially to stop in 2025 at 240 funds, which is what I mentioned before. Now a bit on the market breakdown, similarly to the total market here by asset class, but just for the SSA focus fund. So you can see it's the same, dominated by private equity strategies, followed by private debt and mixed strategies. And on the left, you have the number of funds breakdown of the 240, and then the AUM breakdown out of the 18.9 billion US dollars. Similarly, you have the breakdown by impact sector. So if you recall, it was multi-sector, climate, and microfinance. So here, the ranking is slightly different, with multi-sector strategies still leading the way. And then you have SME development funds in Sub-Saharan Africa, who are important both in numbers and volume. So you have 63 such funds really focusing on developing the growth of the SME markets in Sub-Saharan Africa, as well as promoting and supporting job creation. And then the third is climate and renewable energy funds. And then you have also an important number, I would say, relatively to other regions, of food and agriculture fund at 27 in number and 1.25 billion in total a year. Then a bit on market concentration. So here I'm showing the top 10 in different categories. So you have the top 10 funds, and then top 10 investment managers, the domiciles, and the manager headquarters. So you can see that within the 240 funds, the market is relatively concentrated. You have nearly 28% absorbed by the 10 largest funds, and then 36% by the 10 largest asset managers, and then 90% by domicile, with Mauritius really leading the way with over 30% of absorption in total AUM. And then in terms of headquarters, what's interesting and also aligned with current industry narrative, and there is more than half of the AUM that are managed by companies that are located in Sub-Saharan Africa. So it brings, the local expertise, the proximity towards the portfolio companies in one, but also the possibility potentially to also attract investors from the region, which is a big topic in terms of the ability to have better local capital mobilization in the market overall. So it is a signal that we are monitoring over the years. We believe this number has been growing, whereas at the beginning, maybe 20 years ago, there was a lot of more concentration, with managers being located either in the US or in Western Europe, which is still the case, but more and more going across the different regions locally domiciled investment managers. Now, I focused on the 240 funds. The next couple of slides will really be on a subset of that. So that's thanks to the survey that we do every year, which to which the impact GPs and the funds give us data on the commerciality of their funds, the risk profile, the cost, the regional allocation, the country profile. So everything that enables us to produce the aggregated market report that's going to come out soon. So this is based on this type of data. So it is a subsample within the 240 SSA focused funds. So a couple of slides before I finish. So a bit on the growth patterns. Here you have the total asset growth on the left and the impact portfolio growth on the right. This is for median observation for a subsample. So you can see that the dotted line is Sub-Saharan Africa. Then we compare it with other single regional strategies, as well as the green line, which is the multi-regional strategies. We can see that the growth has been, in terms of total assets, a bit above the other regions, I would say. In the last couple of years, a bit flat in terms of the asset growth, which means there has been maybe a bit of difficulty in terms of new investors and new fundraising. But then on the right, it shows a bit more the deployment. So you have the assets that can include, the cash once you raise money until you actually deploy it and allocate it to your portfolio, which is something that we see on the right, where the portfolio has still grown, at least in 2024, quite heavily for Sub-Saharan Africa focused funds. Then this one I'm going to skip with the interest of time. Here it shows you the countries of investment. So you have, the top 10 largest exposures, with the top 3 being South Africa, Kenya, and Senegal. And I guess in the panel, we'll also discuss a bit on that. But you have here the percentage of country portfolios across SSA focused funds. Then a bit on investor backing. So who are really funding those vehicles to be able to then, on lend or invest in equities. So here you have, again, the comparison between SSA focused funds on the left, all the way to the multi-regional funds on the very right. And you can see that public funding is really one major component of the capital structure of those funds at 82%, much more than in other single regions and even more than in multi-regional strategies. So you have, in contrast, only 15% coming from, these institutional investors, which is going to be also a topic in terms of investor gap and possibilities to mobilize private capital in the panel. So something to keep in mind. And that leads to the importance also of blended finance structures that we see within SSA focused funds. So we know that out of the 240 funds, we know that at least 91 are structured as blended finance funds, and this represents 38%, which is in fact by far the most relative-wise across all single region strategies. And these 91 blended finance funds, they accumulate at 6.7 billion USD in total AUM. They are managed by 77 different fund management companies. And the charts at the bottom, they show you a bit the instruments that are used in terms of de-risking mechanisms. On the left, you have the number of funds using, single kind of instrument, being first loss, concessional capital, technical assistance facility. And you have 33 funds that employ a mix of those kinds of de-risking instruments. And on the right, we accumulate also the multiple blending structures, and we go one step further and try to classify the largest instruments used. And by far today in Sub-Saharan Africa Focus Fund, it's concessional, including first loss capital, as well as technical assistance facilities. Then a bit on return drivers. So for debt strategies, that just to show you without going into the details, that these are the types of indicators that we try to monitor and try to get good data on. So in terms of what is the income on the portfolio that is being lent, the portfolio yields, what are the cost structures in terms of management fees for the GPs, the loan loss provisioning in terms of risks. All these can combine to then derive a bit of insights on the net returns, the financial performance, the financial sustainability of these strategies. We have much more also in the reports. And then to finish a bit on the non-financial, non-economic aspects of these funds, we also cover a lot of IAM practices, outreach, outcome metrics within the report. So here, a few snapshot on some of the indicators that we cover. There are many more. Here, a bit on employment support within always at the fund level, the number of end clients financed, comparing the SSA funds with all funds, as well as the country allocation in terms of income levels, showing that within the Sub-Saharan Africa portfolio, naturally within the low, there's much more low income, exposure in terms of economic income within the countries, simply because of the regional bias. But it's something also very important to consider when we talk about outreach and the potential impact and financial gap that these funds are able to mitigate. So that's it for me. I invite you to, here is the QR code if you have time, but don't worry, the hyperlink will be shared by Boris in the chat function. So thanks for your attention. I'll give back the floor to Boris and to the panel. Thank you.
Thank you very much, Ram, for this great presentation. I have indeed shared the link to the report, to sign up for the report at the beginning of the presentation. So you'll find it all in the chat. Thank you very much. Really very insightful. There are two numbers that stick with me. 82 is one number, but using two situations. 82%, both the amount of public funding that goes into impact funds, and 82%, and I didn't see this before, but that also is a number of the amount of fund invested in low income countries, which I think it's not a surprise that in fact these two are matching. Yeah, very interesting insights. Allow me to now invite Nadia Kouassi and Tafadzwa Nyagano to join. Nadia is with AFCA, the African Private Capital Association. She currently serves as head of research analytics, where she oversees the production of market intelligence, industry data sets, policy relevant insights, and strategic knowledge outputs that inform global and African institutional investors, policymakers, and development partners. Tafadzwa is a senior leader at the African Venture Philanthropy Alliance, AVPA, and serves as chief financial officers. He plays cross-cutting roles spanning finance, investment mobilization, research, and program strategy. And he has also different roles within AVPA. Maybe before we get into more questions and more really what we are here to discuss today, could you both, Nadia first and Tafadzwa then, introduce very briefly your respective organizations, their vision, mission, and objective, so you understand how maybe they are aligned, how different they are, and how they complement also in terms of research, the work that Tameo has presented us. Nadia, over to you.
Good afternoon, everyone, and thank you, Boris, for having me today. So my name is Nadia Kouassi Coulibaly. I'm head of research at the African Private Capital Association, AVCA. So for those who don't know AVCA, it's the Pan-African industry body advancing private capital across the continent. So we've been operating over the last 2 decades, where we have worked to improve transparency, deepen market intelligence, and also support an environment where private capital can scale. So we operate through 4 pillars. So the first one is advocacy, where we help to strengthen an enabling environment to drive investment on the continent. The second pillar is community building, where we connect global and African investors. And as part of this, we will be in Nairobi end of April for our annual conference. The third pillar is data and intelligence, which are led, and we produce the industry independent and trusted insight on market dynamics and benchmark. And lastly, the capacity building, where we support the long-term resilience, sustainability, and professionalism of the private capital. So I'm delighted to share today insight from our research and look forward for the conversations.
Thank you, Nadia. Tafadzwa.
Thank you, Boris. Tafadzwa Nyagano is my name, as delightfully introduced by Boris. So I'm with African Venture Philanthropy Alliance, AVPA. And AVPA is a unique Pan-African network. I call it unique because I think we're the only Pan-African network that combines social impact investors across the continuum of capital. Our mission is to increase the flow of capital into Africa social investments and ensure that this is these investments are effectively deployed for maximum social impact. So at a grand scale, I think AVPA aims to address the ever-growing SDG financing gap on the continent. And how do we do this? We want to crowd in incremental capital, especially private capital, into social investment. So our network really just seeks to achieve greater, social collaboration, exchange best practices, and enhance skills, which is the reason why we're here.
Thank you very much, Tafadzwa. Nadia, let me get back to you. And so basically, we've heard that AVCA acts as trusted independent source of information in satellite intelligence. You provide a wide range of research with different kind of focus on private equity and venture capital, some very specific on gender, etc. Now, I would like to focus on your private capital activity in Africa. The launch of this report is actually tomorrow. So it's a bit of really like a primer and really like early insights that you can share. But can you please maybe tell us, share a few insights on the 2025 private capital activity in Africa, and tell us how your own research, this one, is complementing Tameo's private asset impact funds reports.
Thank you, Boris. Yes, indeed. Tomorrow we release our African private activity report. And in a nutshell, if you have to remind one thing, is that Africa private capital market recalibrated in 2025 and showing resilience amid global uncertainty. So looking at three levels of activities: fundraising, investment, and exit. I will start with the fundraising landscape. So African fundraising reflected a more selective and disciplined global capital cycles, where Africa focused final closes total 2.7 billion, which represented a 34% decline compared to last year. And this mirrors exactly what happened in the global landscape, and reflecting the tightening liquidity conditions as global fundraising and fund count also contracted. So in this environment, African fund managers responded with greater sector specializations and thematic strategies, while African investors sustained their participation, gradually increasing, but maintained at 21% of total commitment. On the other hand, what we saw is that DFIs continue to anchor the capital allocation, representing 64% of the total value of fundraising. So this is perfectly in line with Tameo portfolio level investor analysis, showing that public and catalytic capital still underpins African focus fund, and I believe it was 70%, which is close to our 64%. Both AFCA and Tameo research in terms of asset class highlight the continued centrality of private equity in the market. However, AFCA data research point to an evolving landscape over the last 5 years, where VC venture capital dominates new fund formation, private debt is on the rise, and infrastructure funds remain also a consistent part of the strategies available on the continent. So this is on the fundraising stance. Moving on to the investment activity. So we've seen that the investment activity in 2025 signaled a market that is stabilizing over the last 3 years. With 5.1 billion invested across 530 deals, which represented 8% year-on-year increase by deal volume and a slight 5% decline by deal value. In terms, again, of market transformation, so what we've seen is the composition of the capital flows continue to evolve, with private debt becoming more prominent. Venture capital value is concentrating more toward mid-market opportunities. And lastly, the regional growth patterns highlight both established hubs, the big four that we know: South Africa, Nigeria, Kenya, and Egypt, but also investment in emerging destinations such as Cote d'Ivoire, Senegal, and Gabon. Overall, in terms of geographic distribution of investment, Southern Africa continued to lead by volume and value, and East Africa made the second position in terms of total deal value invested in the region, and thanks to the pool of investment in renewable energy. Again, in line with Tameo report, pointing the fact that we have a strong exposure of impact fund into established hubs such as South Africa and Kenya, but also allocating to frontier markets. So we kind of find the same finding. Lastly, but not at least, is that the clearest positive signal in 2025 in the private capital landscape came from the exit environment. So we have recorded 81 exits, up 27% year on year, the second highest on record for the industry. This signal definitely a slight improvement in liquidity. And in terms of buyers, so trade buyers remained central to realization last year, while sponsor-to-sponsor secondaries gained traction. And finally, last point on exit is that we observe a gradual conversions of holding period in Africa, converging with the global benchmark, so 6.7 years in Africa compared to 6.5 years in the global market, pointing again to an improving market maturity. So that is, in a nutshell, the key finding of the report, which I advise you and recommend you to have access and read the full report for deep insight.
Thank you very much, Nadia. Very interesting to see that across pure impact and the use of like private capital, we see like similar patterns. It's not a given. It's an interesting insight. I put a link for everyone to kind of like sign up to also join this report from AVCA that will be made public tomorrow. Tafazwa, come to you. You have a clear mandate with AVPA, the African Venture Philanthropy Alliance, to connect like investors with exclusive knowledge, partnership, and opportunities to deploy capital effectively when it comes specifically, obviously, to kind of like for like social impact. I'd like to focus now on one particular initiative with you, and that I had the chance to learn personally while attending the AVPA conference last year in Nairobi in November. That is a social investment in action. It's an AI-powered dashboard of recent activities, obviously in the social investment space that cover 54 African countries. Could you please tell us briefly how it works, the type of information you track and share, and maybe share like a few key insights from that? I also put straight away, before I forget, the link to have a look at this tool in the chat.
Thank you so much, Boris. So it was interesting to see that even when the report was being presented, we had questions around. I saw people typing in chat. Do you have such information on forestry? Do you have such information on water, or country-specific, information? So the social investment in action in Africa, which I'm going to call CIAF, is at its core, it's a social capital intelligence platform. Really, it was built to address the critical challenge facing the investment sector. How do we process, how do we structure, how do we act on vast and fragmented sort of landscape of data, which is, I think we have so much data on impact, but how do we process it in such a way that we can make quick, low cost and effective decisions? And what sort of brought about this initiative was just the sheer volume of and fragmentation of impact data across Africa. So what the platform does, I think on how it works, the platform really, on average, it's currently accessing about 200,000 English language news sources globally every month, and extracting the sort of Africa-centric impact information through AVPA member organizations in relation to the impact initiatives and activities that they're undertaking. So just to contextualize it, I think in the first iteration, about 1 million articles were actually scanned, and an estimated about 8,300 impact activities were identified. These activities can be filtered per region, per sector, and what this does in essence, it just allows for, it's almost like social capital mapping, right? It maps the full landscape. You can choose and select the actual region that you want to sort of focus on. It allows for strategic decision support, so it just reduces the time that you're going to spend trying to sort of collect data. But most importantly, I think it allows for collaboration opportunities, because you can actually get to the core of seeing who is investing in what activity in which area. So maybe as an investor, as you go into a new region or into a new sector, you're actually able to narrow down into the current sort of active players. The dashboard also just allows for trend and gap analysis, where you can then identify the impact momentum and where you could play a key role. So I think in essence, we're talking opportunity identification, due diligence support. The platform can help with that. Portfolio monitoring, and I'm glad you've shared the link for people to please access a 7-day trial. Some of the insights that we seeing currently, I think there's always I won't call it a mismatch, but it's interesting to see how the quantum of investments, say for example within the health sector, you've got less activities in certain regions, and which are similar activities are being funded by a larger volume of larger quantum of funds in separate regions. But like I think in the main, we now have this dashboard which allows you at the click of a button to filter and narrow down to specific information requirements.
Thank you very much, Tafadzwa. This was very insightful. I think now we had a different look at like the different type of capital. Let's say the more like commercial with AVCA on private equity venture capital, something that is like impact with Tameo, and now something which is really focusing on like social impact with AVPA. Different roles. We're still talking. So we still like strong overlap between a lot of like these different pools of capital and how they act upon the development of the continent. Now we talked about data and information. Now what we're going to be interested in is like how can these data be concretely used to mobilize capital and inform allocation decisions. And to discuss with us, I'd like to invite now Safeya Zetoun. She is the CEO of Tameo Impact Fund Solution, colleague of Ram Kumar, who presented the research earlier. She leads strategic initiatives to support investors in navigating the evolving regulatory framework and impact reporting requirements, ensuring greater clarity and alignment with industry standards. Safeya, since you just joined us, I'm gonna start with you. So we've seen now different research, Tameo, Africa, AVPA. All this data is gathered to measure impact and, more importantly, to mobilize capital toward impactful solutions. So from your perspective at Tameo, can you tell us what are the main bottlenecks that still hold back the deployment of impact capital on the continent, whether data gaps, risk perception, or else, and maybe how does Tameo's work help address them? Over to you, Safeya.
Thanks a lot, Boris, for having me. Good afternoon, everyone. First, for a big thank you to Building Bridges for organizing and for inviting us to speak at this webinar, and to everyone for their contributions so far. I think what we can already see through the data that was presented by Ram initially, and which was complemented, of course, by Nadia, is that there is a great deal of interest from investors in Sub-Saharan Africa, from both the public and the private side, but predominantly from the public investor side, since we saw that it is the single largest regional strategy in our universe of private asset impact funds. However, the absolute volume of capital remains small. We have fund and ticket sizes that are well below the global average. And it's really this gap between interest and deployment that I want to talk about. And I think that there are three key bottlenecks that really reinforce each other. And the first two I'll kind of talk about together because we already alluded to them quite a bit around transparency and risk. So it's very clear that the work that we are doing at Tameo and the work that AVCA is doing is trying to fill a gap in data on private asset investing, and for us more specifically private asset impact investing in Africa, because there's otherwise very little coverage through mainstream data providers. There are no widely available benchmarks today, not even around market characteristics, let alone around performance. And this creates a big issue for for investors that perceive or experience very concretely that due diligence costs in Africa are expensive and processes tend to be slow. We are actively trying to address this with the type of research that Ram presented, building comparable fund level data on this segment, trying to make the whole sector more accessible for investors so they can understand capital flows by country, by sector, by asset class, and the investor composition. We certainly gain more and more coverage every year, but the market is far from transparent enough. And very interconnected with that is the topic of risk perception. Of course, for international lenders, there tends to be this unfortunate approach of lumping together all of investments in the African continent together, looking at topics around currency fluctuations, political instability, exit opportunities, etc. And these are very real risks that people have experienced, but they're not uniform at all. Nadia was just talking about improvements in the exit environment recently, improvements in liquidity and convergence in holding periods. And we've seen a lot of currency rebounds in terms of appreciations against the dollar in 2025. So we cannot assume that all of the performance and risk metrics across the African continent are equivalent. And what we need to understand and what we've already started doing is the performance at a much more granular level. So Ram was showing us that we have some KPIs today on debt strategies in terms of portfolio yields, provisioning levels, fee structures, etc. But this is a relatively small sample, and this idea of delineating between the actual risk and performance versus the perceived risk is something that we certainly need to continue to work on. So I would say this is a call to action for all of the fund managers that may be joining us or listening to this later to share their data in our next private asset impact fund survey so that we can improve coverage in the future and bring more information on this. And I'll close with a final point here around the points that we heard from Tafadzwa on the impact side. So the impact comparability remains a challenge in the market and remains a bottleneck, especially for those impact investors that are mission driven and for whom the impact performance is a key criterion for allocation. So I'm talking about foundations, venture philanthropists, public agencies, etc. Today, there is not very good information on dollar for dollar, where will you achieve the most significant impacts across the African continent. And this is an issue that is prevalent across the impact investing industry, not only in Africa. And already the initiatives such as that by AVPA are working to bring more transparency there. And we are also at Tameo doing more work to support impact investors with their data collection, reporting, and impact verification to improve comparability and credibility of impact reporting and performance in the future.
I was muted. Thank you. Thank you very much, Safia. More granularity, more data, and also really make a difference between the different regions, the different countries, the different sectors. As investors, see where more like maybe public funding is needed, but also, and therefore for impact, but also where there is in fact space for more like private investments with commercial returns. Thank you very much. Tafadzwa, in the past couple of years, we've experienced obviously a reduction in ODA when we see that 82% of impact funds come from public cap money. It is an issue. It affects Africa front and center. So you are located at the intersection of like social impact and investments on the continent. You have a role to play in filling the gap. And so here is my question. So are you already noticing an evolution of the business models of social businesses and impact first ventures? And are philanthropists increasingly moving towards venture philanthropy with the hope to mobilize other sources of capital while potentially being able to recycle theirs? This is my question to you, Tafadzwa.
Thanks, Boris. And you reference in the past years. I think the current time, this conversation we're having is timely. I think these geopolitical shifts will impact Africa more than many from a aid perspective. So yes, I think we have certainly seen the reduction in aid as a counter. There's also an acceleration in the evolution of how social businesses and impact-first ventures are operating in Africa. Our role as AVPA, I think we have even taken a step back to say maybe there's a capacity building, role that we could play. So we're trying to educate investors on what is impact investing. So I think tomorrow we also kick off our Africa Impact Investing Fellowship course. But we, to Safia's point earlier, we have seen the need to build capacity even around impact measurement, right? But for social for impact-based businesses, we've really seen that change towards more sustainable and revenue-driven models. And I think there are examples that I could name, like M-Copa, I think in East Africa, they moved from the solar energy solutions to a pay-as-you-go model. I think Zipline in Rwanda, in Ghana, but even more so now, we have had partners who come to us and say, these are our beneficiaries who traditionally have been aid dependent. How can you make them investor ready? How can you make them to start thinking on how they could attract, some capital and just appreciating that you can do good and do well at the same time. From a philanthropist perspective, I must say that there is definitely a shift. I think philanthropists are embracing the change. We have seen the usual, I'll call them usual suspects. So your leaders, your Bill and Melinda Gates Foundation, or Media Network, for example, they are really already structuring investments to recycle capital and co-invest with impact funds. So they are actually unlocking additional private capital to come into this space. But I think what would be more interesting will be, how do African philanthropists learn from the leaders within the space? But certainly, I think what has been a challenge in terms of the decline in ODA has also just seen Africa and those on the continent sort of try to rise to the challenge.
Thank you very much, Tafadzwa. And indeed, we'll get back to this later. The importance of local capital mobilization is very important to address the current cuts globally. Nadia, we are not going to get straight away on the local currency solution, but I think we'll touch upon this in a minute. But what I would like to focus on with you is on the African institutional investors. They have an important role to play in the development of private capital markets on the continent. Can you please tell us how they are currently engaging with private capitals and what would help incentivize greater participation and larger allocations of private capital markets over time? The floor is yours, Nadia.
Thank you, Boris. I think it's good to remind the context of African institutional investment in a private capital asset class. African pension funds undeniably represent the continent's largest pool of long-term investment. However, across key markets, there remains a significant gap between the regulatory allocation limits for alternative assets and actual deployment. So I'm going to share some examples. For instance, in Ghana, pension funds currently allocate only 0.5% to alternatives, compared with the 5% government-mandated minimum and a 25% regulatory limits. Moving on to South Africa, where pension assets exceed $150 billion, but allocation to alternatives remain below 1%, despite the 15% allowance. Even looking at certain markets with more conservative limits, such as Nigeria, 5%, and Kenya, 10%, the mobilization opportunity is massive and significant. So closing even part of this allocation gap could unlock billions of dollars for private capital industry and reduce reliance on international capital sources. So there are plenty of strategies and solutions, but for the sake of time, I'm going to focus maybe on 2 or 3. I will start with one that Safia already mentioned, which is very critical: improve targeted data and transparency. because limited availability of reliable market data continues to constrain institutional investment decision in private capital. In the AFCA's knowledge exchange initiatives with Ghanaian pension stakeholders, 60% of the respondents cited insufficient market data as being the key barrier for the investment, for the allocation to the asset class. So strengthening transparency, consistency, and access to data and intelligence benchmark can help pension fund definitely build conviction and also trust in the asset class. And AFCA has, following this program, within the program, developed a dedicated, for instance, Ghana Private Capital fact sheet, providing just baseline data on the economic context, investment activities, and fund landscape. And this initiative helped deepen engagement between pension fund and private capital stakeholders. So I think organizations such as AFCA and MAU role in the industry is important, but also we invite fund managers to collaborate and share data, because we all part of this big story and sharing the story of Africa. So this is the first strategy. The second strategy, or strategies, I will put under the bracket of collaboration to build scale and share risk for pension funds. So the first one is collaborative investment platforms, which can help pension funds overcome constraints related, for instance, to ticket size investment, internal capacity, and governance by maybe enabling a pool of participation in larger and more diversified investment opportunities. Second, two options, structured co-investment, allowing domestic, again, asset owners to access opportunities that may otherwise be difficult for them to source or evaluate individually, whilst also helping them to build experience in and confidence in investing in the private market over the time. An example is the Africa 50 Infrastructure Acceleration Fund, which brought together African pension fund alongside international investors. And if I recall correctly, they had roughly 22 investors and 20 were African pension fund, which is very, I would say, good sign and positive. It was a good play on the hand. Lastly, for the sake of time, I will mention the critical role or expanding role of local currency solution, which is definitely another avenue to mitigate, for instance, currency risk in Africa. So that was here.
Thank you very much, Nadia. Actually, let's pick this up straight away. We have like 8 minutes, but if I can just ask you to give us like a couple of like local currency, how they are evolving these local currency funds is part of the solutions. Are there like really progress on like the development and adoption of these local currency funds? Just in 1 minute, if you can, we are like a little short in time, unsurprisingly.
So yeah, definitely. We've seen an uptake in the local currency fund in Africa. So over the last 4 years, we've reported 35 funds reaching internal final closes. And in terms of geographic distribution, South Africa dominates around 60% of local currency dominated. And we also saw like increasing alignment between fundraising and deployment geography, where almost 70% of the local currency funds are country-specific, raising and investing in the same market. Maybe 2 examples: the Sanari Capital 3S Gold Fund, which is a bond-dominated PE fund that have raised 1.5 billion bond, and also the Injaro Ghana Venture Capital Fund, which has raised 216 million CD in the Ghanaian market, again, gathering primarily domestic institutional investor led by pension fund and asset management. And just to close, this trend is likely to deepen and continues as per the conversation that we have in the industry, and also investor, more than 60% of the fund managers expect this incremental adoption of local currency over the next 3 years.
Thank you very much, Nadia. So transparency, collaboration, and the expansion of like local currency solutions and funds in particular seen as key to mobilize more local domestic capital. Thank you very much for this. Now, I think one important point, and we saw, I think, 68% of funds used like a first loss. Tafadzwa, can you tell us a little bit about like the importance of like concessional capital? And we are really again short in time, so I would value like a short answer as well. Thank you.
Thanks, Boris. The short answer is we believe no one is best positioned to provide first loss, to take first loss positions, to offer guarantees more than philanthropists. And I think we are seeing foundations like Rockefeller that have supported innovative financing structures because we need philanthropists, to actively de-risk investments to unlock, the capital that Nadia referenced earlier.
Thank you very much. Indeed, this also speaks to the first question about the role of the evolution of philanthropy to get more towards venture philanthropy, probably seen as key to kind of unlock more capital and for an increased impact with with capital currently available. Safeya, blended finance often presented as a way to crowd in private capital based on Tameo's research. How widespread are these structured among African-focused funds? And how well do we understand what actually works? And my question is obviously about the second part. How do we understand what actually works?
I mean, I'm going to give a not very great answer because we don't understand what actually works. That's a bit the disheartening point. I mean, we do see from a purely mechanical perspective that for a lot of African-based or African-focused private asset impact funds, the blending aspect, the public capital, is not a peripheral aspect. It's not a nice to have. It is something that's actually a precondition for many funds to exist at all. So they would not have been able to reach a first close or to reach critical mass without this public capital. What we are not able to comment on today is which forms of blending are the most effective and what their impacts are from a financial or from an impact perspective. I think this is a very important point to mention for everyone in the audience, that the evidence is simply not there to say it's the most optimum to have a 10% first loss tranche or a 20% guarantee or technical assistance for every single investee in the portfolio. We cannot answer this question. I think end of 2024, there was a report from the Columbia Center on Sustainable Investment commissioned by the SDG Impact Finance Initiative, which made an attempt to estimate the returns of blended finance portfolios. But this already tells you it didn't work because the data quality was insufficient. And this is something that we are actually actively working on today. So just to tell everyone in the audience that at Tameo, we launched a new partnership together with ETH Zurich and the SDG Impact Finance Initiative to examine the fund architecture and de-risking mechanisms of blended finance structures, not only for African vehicles, but for all blended finance funds worldwide. And we're adding here novel data from the financial statements of blended finance funds to try to really understand better this aspect of how does blending affect both financial performance and impact performance. So just to follow us and keep an eye out on this, and we'll have some interesting publications on this over the course of 2026. And I'll close here. Thanks a lot.
Thank you very much, Safeya. I see a comment from Dr. Hubert Denso. Blended finance will never scale. That's the structural misperception. We have 2 minutes? I need to close at the end. Dr. Hubert Denso, do you want to take the floor for seconds and tell us in maybe 30 seconds a little bit more about that? I don't know if it's
hello, sir. Can you hear me?
Yes.
Yes. No, thank you very much. It's really just a slight observation that the challenge that we have in the market is this has just become a development community product, which happens to rely on the African continent, and therefore all of the capacity and opportunities are limited to the size of the balance sheets of the multilateral development bank financing system. So you have a system that has been structurally designed around a global MDB balance sheet of about 3 trillion. And as a consequence, it's disintermediating 300 trillion of institutional capital that's not market aligned. So that therefore, the majority, and we sat on President Macron's Global Financial Pact Summit that looked very closely into this. If you take all of the proposed reforms for the multilateral development banking system as it relates to private capital mobilization, because of that constrained balance sheet and the model, only 8 to 10% of the private capital mobilization requirements for Africa and emerging markets and developing countries can be met, which basically means that the model needs to be redeveloped and structured so that it can actually crowd in the 300 trillion and be market aligned, benchmark and eligible and linked into allocations. And I think we are fundamentally continuing to go in to try to squeeze this small lemon rather than open up this bigger pool of capital. And we coin it in one phrase. If we really seriously want to be able to mobilize capital at scale for impact and for emerging markets and developing countries, we have to stop trying to make investment developmental, and we have to make development investable. Thank you.
Thank you very much. I think this is a very nice conclusion to this webinar. I would maybe add one thing. We have today America that is become more volatile, Europe that is aging, China is slowing down, the Middle East is riskier than ever. So there will be in what can be considered investable opportunities in Africa as well, in other emerging economies. It is coming.
We shouldn't be dependent on other markets. We have a very compelling fundamental value proposition. We shouldn't be driven and swayed by an economist headline or what's happening in the rest of the world. We should stick to what our own fundamentals are. We used to be in past centuries over 14% of global GDP. We must take away this perception that we are this development project that needs help. We are one of the most thriving, fundamentally positioned global economies. And I think until we get that mentality and move away from this development charitable brand that's been put on us recently, I don't think we're going to move forward with these impact models. Thank you.
It's absolutely right. Thank you very much for these comments. Thank you very much, Dr. Hubert Denso. Thank you very much to all the panelists today. Safeya and Ramkumar at Tameo, Nadia at AVCA, and Tafadzwa at AVPA. It's been really a pleasure to be with all of you today. The recording will be uploaded in the coming days, as well as the links shared today and the slides presented by Ram. There will be a short survey shared with you. I invite you to fill it if you can. And keep in mind that Building Bridges 2026 will take place from October 6th to 8th. Thank you very much to all, and I wish you all a great